Welcome back to Weekly. Joining me now to chat about the outlook for markets in 2020 is Ian de Verteuil, the equity strategist at CIBC Capital Markets. Ian, thanks for joining me again on Weekly.
Great to see you, Andrew.
So looking back at 2019, you thought markets were going higher. You had no idea they were going to go as high as they did go, but it's not bad on you because join the club. I was in the same camp. But in a recent note, you commented that markets went up so much last year that there's no way it didn't borrow from the outlook for 2020.
Correct. I absolutely think so. A lot of things happened in 2019. We had a terrible start to the year because 18 was we closed really at near lows on a whole variety of things. That was one element. But really, the driver was the decline in interest rates and an improving trade environment. Virtually no help at all, not virtually none, no help at all from earnings. We actually had sentiment driving the performance.
Yeah, I saw a report that said 97% of last year's return on the S&P 500 came from multiple expansion.
Had to be, because we've had virtually no earnings growth. Now, we're not completely done on 19 earnings. We're actually in the heat of it currently. This is the first week of actually seeing Q4 earnings. But I think it's safe to say virtually no earnings growth at all in 2019 in the S&P 500.
So as you look out to 2020, markets appear to be discounting accelerating global growth, including stability, if not accelerating growth in the United States. Part of it's organic, trade deal gets done. Part of it's got to do with the expectation of big fiscal stimulus in Europe, even some in the States. Do you think we're going to, when we go out 4 or 5 months from now, are we actually going to see evidence that global growth is reaccelerating? And if we do, what does that mean for markets? And if we don't, what does that mean for markets?
Sure, it's very, very difficult to see us reaccelerating growth here.
Why?
Well, the main reason I think is when you think of the fiscal stimulus, most of it really came into the Tax Cuts and Jobs Act, which was a massive tax cut at that particular stage. We will see some infrastructure spending, but really the big issue is the rate of change of which these are occurring, and it is not impossible, highly unlikely we'll go back to that type of stimulus. We will see increased deficits out of the United States. So I think that's one element I would certainly say. The second thing I would say is we're not seeing any fixed direct investment at all. So we're not seeing capacity really built into the United States in any meaningful way. We're running effectively at max levels of employment, currently very low unemployment rates. So it's very difficult to see what the trigger is to get us moving from. If you're not seeing businesses actually spend and we don't have a lot more people to employ, it's hard to actually believe we're going to get a pickup in there. So to me, earnings estimates on the S&P 500, which are currently 10% earnings growth in 2020, which is very difficult to believe in an environment where we're really seeing less than 2% GDP growth in the United States. So I think that has to come down. So to me, I don't see it happening. What happens if it doesn't? I think we start to have earnings estimates revised downwards, and I think we start to see a bit of pressure on equities as we move forward. This particular month, January, is a very important month because a lot of companies provide year-ahead guidance. At this stage, you report your Q4 numbers and then you talk about the future. And I think we're going to start to see that be tempered quite a bit out of U.S. companies. So that's why I think the S&P 500 is going to have a difficult year, ending much higher, I think, than where we are currently.
Does China reaccelerate? Does European growth get better? Do we see big fiscal stimulus in Europe?
Yeah, so I do think we're going to see, my guess is, our view is on China, we're going to see relatively stable growth at probably around 6%. In a lot of ways, they have the capacity to do more fiscal stimulus, and because it is a centrally managed economy, they can actually move more levers than we can in developed economies.
But are those two territories, Europe and China, going to contribute to reaccelerating global growth?
Hard to see how Europe's actually accelerating. We're going to see some fiscal stimulus, but the structural issues, and particularly Germany, where we continue to see awful numbers coming out on a regular basis, I just don't see any sign that that's improving meaningfully.
Okay, so that if we don't see reaccelerating growth, that implies that we're probably going to see some rotation out of the value and cyclical area that started big time in August, September, October, sort of fell apart late December, and certainly has fallen apart year to date, where growth and momentum are kicking the derriere of value and cyclicals. So you see rotation back?
So to me, I do think when we go to slower growth, I do think value actually kicks in at that stage. I think you will start to see companies trading at lower PEs with big yields actually start to do better. So I think we will get, I think value, we've had a year, certainly 19, a lot of very narrow, as you rightly say, outside of the last quarter, very narrow performance, big growth stocks really contributing, and we started to see that earlier this year. I do think once we get the earnings growth starting to slow down and markets become much more reasonable in their expectations, I think the value stocks will actually come back.
So you don't think growth is going to reaccelerate, but you actually believe that'll help value stocks?
I would think so.
Because if growth does not reaccelerate, long-term bond yields aren't going to go up, and typically rising bond yields are better for value and cyclicals.
So the rate issue is a peculiar one. I mean, I think anyone looking at an economy with 2% inflation, to have the US 10-year yielding 175, that just doesn't make any sense.
Right.
We have a distorted long-term interest rate environment. Now, that's been a big driver, I would say. From our point of view, when I think about risks to the market, one of the risks which nobody expects is that interest rates can actually rise in an environment where the economy is so-so. But it can happen because we are in a period of time where there's massive requirement to actually borrow money in parts of the world, and we're going to see some fiscal stimulus. We tried monetary stimulus, didn't really work. We're now going to try fiscal stimulus, didn't really work. But both of those things actually argue that we can get rates moving somewhat higher, even in an economy that's not doing terribly well.
So there's so much money in the growth and momentum space. I've pondered out loud that if 10% of the holders of the $5-6 trillion worth of growth momentum stocks, the large cap ones, sell 5% of their holdings and pile into cyclical and value stocks, they can go up a lot, the cyclical value stocks, but the weight of the market in them isn't that much. And therefore, you see big sector rotation.
But not much movement on the market,
right.
or even a bit of pullback.
You agree with that?
I absolutely agree with that. We have so much index money. We have so much of those things that have just latched on to these individual momentum stocks, these big growth stocks. And that is a vulnerability. I am concerned. I mean, it is pretty clear that today, 25% of all large cap stocks are indexed. Right. That's an amazing number, right. And it just pulls people in. So I do think there's risk on that concentration.
And in my wrap, just before our chat today, I commented to viewers that I think the Fed's balance sheet expansion is what's driving markets today. You agree?
Absolutely.
Yeah, okay. Thanks very much, Ian.